Are you looking to grow your wealth while getting paid in 2025? Then dividend stocks should be at the top of your watch list. But not just any dividend stocks. The best ones for 2025 are the perfect balance of high yield, steady growth, and real staying power. In this video, we're not recycling the same old lists from last year. We're diving into fresh, up-to-date picks that are not only paying consistent dividends, but also poised to benefit from current market trends. From reliable US blue chips to overlooked international giants, and even a few hidden gems in the renewable and tech sectors, you'll get a smart, diversified list built for income, growth, and long-term security. Whether you're a beginner or already building passive income, this is your ultimate 2025 dividend guide. Let's get into it. So what exactly makes a dividend stock worth owning in 2025? With interest rates still hovering above 5% and inflation slowly cooling off, the market is shifting. Investors are no longer just chasing hype, they're chasing income with reliability. That means quality dividend payers are back in focus, but not all dividends are created equal. First, you want a sustainable dividend yield, ideally between 3% and 6%. Stocks yielding over 8% might look attractive, but many come with high risk or unsustainable payout ratios. Next, look at the dividend growth history. Has the company increased its dividend every year, even during downturns? That's a green flag. Now pay attention to the payout ratio, which tells you how much of a company's earnings are being paid out as dividends. A healthy range is usually 40–60%. Anything too high could mean the company is stretching its cash flow just to keep investors happy, which often ends in a cut when earnings dip. You also want companies with strong free cash flow, low debt-to-equity ratios, and a solid business model in a sector that isn't going away, especially in 2025. For example, with rising demand in defense spending, AI infrastructure, and green energy, dividend stocks in those sectors are positioned to not just survive, but thrive. And finally, consider valuation. With the S&P 500 still near all-time highs, now is the time to look for undervalued dividend stocks, not just high-yield ones, but those with room to grow. You want to lock in income? Yes, but also capital appreciation over time. Let's start with the backbone of any dividend strategy, top-tier US companies that have a proven track record of paying and growing dividends, even during market turbulence. These aren't speculative plays. These are stable, reliable businesses with strong cash flow, solid earnings, and shareholder-first policies. First on the list is PepsiCo, PP. With over 50 years of consecutive dividend increases, Pepsi isn't just a beverage giant, it's a recession-resistant cash flow machine. In 2025, as consumer staples continue to outperform during economic uncertainty, Pep remains a cornerstone dividend stock with a yield around 2.8% and consistent growth. Next is Johnson & Johnson, J&J, a dividend king and healthcare juggernaut. Even with recent legal headwinds, J&J's diversified revenue from pharmaceuticals, medical devices, and consumer products provides resilience. It currently yields just over 3%, and in a healthcare sector seeing global growth, it's as close to buy and forget as it gets. For tech exposure, consider Texas Instruments, TXN. It is one of the few tech companies that not only pays a healthy dividend, currently around 3%, but has increased it for 19 consecutive years. As AI and IoT demand more semiconductors, TXN is quietly riding the trend while rewarding shareholders. Procter & Gamble, PG, also deserves a spot. With brands in nearly every household, Tide, Pampers, Gillette, PG offers global exposure, defensive stability, and over 65 years of dividend increases. Its 2.4% yield might seem modest, but the real value is in the steady upward trajectory. Finally, a wildcard pick, Lockheed Martin, LMT. With ongoing geopolitical tensions and rising global defense budgets, LMT is in a strong position to benefit from macro trends. It yields around 2.7%, buys back shares aggressively, and has grown its dividend for 20 years straight. Each of these US dividend stocks provides something unique: defense, staples, tech, or healthcare. But what they all share is predictable cash flow, strong balance sheets, and investor loyalty. These are the kinds of companies that not only survive in uncertain times, they thrive. While U.S. dividend stocks are solid, limiting your income strategy to one country limits your upside. The global economy is evolving fast in 2025, and international dividend stocks are offering some compelling opportunities, especially as foreign valuations remain lower and many central banks are now pausing or even cutting interest rates to stimulate growth. This opens the door for attractive yields and capital appreciation abroad. Let's begin with Unilever, UL. This London-based consumer goods titan owns brands like Dove, Lipton, and Hellmann's, and it generates revenue across Europe, Asia, Africa, and the Americas. With a dividend yield close to 4% and a long history of steady payouts, Unilever offers a defensive income stream in a volatile global market. Next up is Nestlé, NSRGY. Based in Switzerland and the largest food company in the world, Nestlé is a quiet dividend machine. It has over 150 years of brand power, Nescafé, Purina, Kit Kat, and pays a reliable dividend with an annualized yield of around 2.5% to 3%. With a strong focus on emerging markets and health products, it's a great long-term hold with low volatility. Now let us talk about financials. Toronto-Dominion Bank, TD, is one of the most stable banks in North America. Canadian banks are known for their conservative lending standards and tight regulation. TD has weathered every major financial crisis with ease and pays a yield around 4.5% as of 2025. It's a great play for those wanting exposure to North America outside of Wall Street. And here's a more aggressive pick, Vodafone, VOD. This UK-based telecom giant has been restructuring aggressively, shedding underperforming units and streamlining operations. It offers a yield well over 6%, though with more volatility. If you're willing to take some risk in exchange for higher income, Vodafone is a value play that could reward patience. One thing to remember, international dividends may be subject to foreign withholding taxes, often 15% or more depending on your country of residence. But with the right brokerage or tax treaties, you can sometimes reclaim those taxes or reduce the impact in retirement accounts. Be sure to check how your country treats international dividends before diving in. Bottom line, international dividend stocks help you hedge against U.S. market risk, add currency diversification, and tap into different growth cycles. They're a smart addition to any long-term income portfolio. If you're building a dividend portfolio for 2025 and beyond, sticking only to legacy industries could limit your growth. That's why now more than ever, investors are looking at emerging sectors, industries that are still growing, but already generating real cash flow and paying dividends. It's the sweet spot between income and innovation, and the right picks can offer not only yield, but long-term upside. First up is Brookfield Renewable, BEPC. This company is at the forefront of clean energy, hydropower, wind, solar, and it pays a dividend yield of around 4.5%. With global governments pushing toward aggressive decarbonization targets and trillions in infrastructure spending being allocated through 2030, BEPC is positioned to benefit from both policy support and growing energy demand. Next is Digital Realty Trust, DLR, a REIT focused on data centers. Think of it as the backbone of the internet. Every time someone uses AI, streams Netflix, or stores cloud files, companies like DLR are quietly making money. In 2025, as artificial intelligence and big data continue to scale, DLR's dividend yield of 3.5%-4% becomes even more attractive, especially given its long-term rental contracts with tech giants. Then there's NextEra Energy, NEE. While technically a utility, NextEra is one of the most progressive energy companies in the U.S., combining regulated power generation with aggressive investments in solar and wind infrastructure. It pays a modest dividend of around 2.5%, but its growth is strong, and it has increased its dividend for over 25 years. If you want both climate-friendly exposure and stable income, this is your pick. Finally, consider American Tower, AMT, another real estate play. But instead of buildings, AMT owns telecom towers. As 5G expands and mobile data usage grows, telecom infrastructure becomes a cash machine. AMT offers global exposure, REIT status, and a dividend yield near 3%. It's a great way to invest in the ongoing expansion of connectivity. These emerging sector dividend payers aren't just income plays. They are growth stories wrapped in cash flow. They help modernize your portfolio while still delivering predictable returns. And in a time when the market's narrative is shifting from speculation to stability, that's a powerful combination. Now let us talk about two things that can make or break your dividend strategy: taxes and risk. A lot of investors focus solely on yield, but what you earn matters less than what you actually keep. Let's start with dividend taxation. In the US, most investors will deal with two types of dividends: qualified and non-qualified. Qualified dividends, like those from companies such as Pepsi or Johnson & Johnson, are taxed at the lower long-term capital gains rate, typically 15% for most people. Non-qualified dividends, however, like some from REITs or foreign stocks, are taxed at your regular income rate, which could be much higher. That's why it's important to know which bucket your income falls into, especially if you're in a higher tax bracket. Now, if you're in the accumulation phase and not living off your dividends yet, consider using tax-advantaged accounts like a Roth IRA or traditional IRA. In a Roth IRA, your dividends grow completely tax-free, forever. That means a $500 a month dividend stream in retirement is actually $500 in your pocket, not $500 minus 30%. Holding tax-inefficient assets like high-yield REITs or international stocks in these accounts can dramatically improve your net return over time. As for risk, here's what most dividend investors ignore. A high yield is often a red flag. If a stock is yielding 8% or 10%, ask why. It could be because the market expects a dividend cut or because the company's earnings are unstable. Always check the payout ratio. That is how much of a company always has profits are going to dividends. A payout ratio over 80% is a warning sign unless you are looking at rates or other specialized structures. Also, watch for dividend traps. Companies with a history of cutting dividends when times get tough. This is where dividend growth history matters. A company that's increased dividends for 10, 20, or even 50 years has proven it can manage through recessions, inflation, and disruption. In short, a strong dividend portfolio isn't just about chasing yield. It's about smart placement, sustainable payouts, and long-term discipline. Taxes can quietly erode your returns, and risk can sneak in behind flashy numbers. Plan for both, and you'll stay ahead of most retail investors. So there you have it, your guide to the best dividend stocks for 2025. We covered everything from classic US blue chips to global powerhouses, from high-yield REITs to emerging tech and renewable sector plays. But the real takeaway isn't just a list of tickers, it's the strategy behind it. Focus on consistency over hype, on sustainability over speculation, and on building a portfolio that grows your wealth slowly, predictably, and with real income you can count on. Whether you're aiming for a $100 a month or $5,000 a month in dividends, the journey starts with choosing quality, reinvesting wisely, and thinking long-term. If you got value from this video, please like it, subscribe to the Cash Chapter, and turn on notifications. We drop faceless, data-backed investing videos every single week. And let me know in the comments, what's your favorite dividend stock right now, and how much passive income are you aiming to build in 2025? I personally reply to every comment. Let's grow smarter, build cash flow, and unlock financial independence, one dividend at a time.